Welcome to this webinar, Ebury Webinar, where Ebury's strategy team will try to give you a quick update of what has happened in markets, particularly in currency markets of the last few weeks, and what are the main factors driving all this volatility, and where we expect these trends to take us over the next few weeks into the year end of 2022. As everybody's probably aware, very volatile markets, fear of recession, higher interest rates. We'll try to put together a coherent narrative here to explain you what's going on. So if we go to the first slide, we'll first tell you about what's actually happened with FX volatility spiking, the US dollar soaring to 20-year highs. We'll spend some time talking about sterling, which has been probably the most volatile main currency after this little disaster of the UK budget presentation. We would be amiss if we didn't spend some time discussing the energy crisis in Europe and the impact on the euro, and then a more general bird's eye view of what are the chances of a global recession and what is the impact that it will have on currencies. Then hopefully we'll have some time for do some questions and answer. Go to the first slide. Here's in a nutshell what has happened over the last few months. FX volatility has spiked after 10 years or so of very quiescent markets, very quiet markets. We're finally getting some serious volatility that is reminiscent, though not quite, of the levels that we saw in the great financial crisis almost 14 years ago. Why are markets all of a sudden tense, nervous, and therefore trading becomes more volatile? First of all, central banks continue to raise rates very aggressively, with the Fed leading the way. We probably have another 75 basis point hike coming, especially after we just saw yet another too high for comfort inflation report out of the US. Most G10 central banks are struggling to catch up with the Federal Reserve. They're set to hike well into 2023, again, with a lag relative to what the Federal Reserve is doing. Another factor, obviously, is the energy crisis and the worries about a deep euro area recession should the worst case scenario materialize and rationing become necessary. It's not the base case scenario. I think that some of those fears have calmed down over the last few weeks, but nevertheless, it's still on the back of the mind of traders everywhere. In addition to bringing volatility to markets, this has caused euro dollar to trade below parity again on the recession fears. Special mention again, UK, with that ill-timed announcement of massive unfunded tax cuts, which mean red ink in the UK government finances as far as the eye can see. And that this time has seriously spooked investors and necessitated Bank of England intervention in the bond market to calm things down. Again, the GT performance chart here, the only theme that is pervasive here is that the US dollar is outperforming all of the currencies in the G10. The other thing is that the safe havens like the Swiss franc are performing better in relative terms. And the euro, even though the euro has gotten a lot of press and breaking parity, is actually somewhere near the middle of that performance chart versus the dollar. Again, the main thing here is a flight to the dollar worldwide. We go to the next slide. The dollar is back to the highest level in 20 years in trade-weighted terms. Different indexes give you different results, but essentially, we haven't seen the dollar this high in decades. What has driven this move higher? First of all, the Federal Reserve has taken a hawkish turn, and it has led G10 central banks. All of the central banks in G10 are hiking rates, except for Japan. They will be hiking rates long past the point at which the Federal Reserve is gone, but that's a story for 2023. For 2022, all we see is that the Fed is leading all of the central banks. The fear for global recession and a surge in inflation is driving what we call a risk-off trading theme, where investors fly to safe havens. And in situations like that, the dollar tends to reassert itself as the safe haven of choice. That is another factor that is buoying the dollar. And then the third factor is that in relative terms, the US economy, when compared to all other main G10 economies, is holding up fairly well. The downturn looks set to be pretty mild, at worst, a shallow recession so far. And the strong labor market in the US keeps defying expectations and generating solid numbers of jobs. And the job opening levels continue to be high in spite of this massive backup in interest rates. You put these three factors together and you get a rallying dollar. If you go to the next slide. Obviously, in this environment, you would expect risky currencies to suffer, but what we're seeing is something a bit unusual, which is that while emerging market currencies have also sold off, as expected versus the dollar, they have actually performed significantly better than most G10 currencies. The fact that emerging market central banks in this cycle, unlike other cycles, led advanced countries in tightening in response to inflation may explain this outperformance. Another explanation is that the inflationary background has meant high commodity prices, and high commodity prices tend to be overall positive for emerging markets, which as a whole are net exporters of commodities and benefit from the higher prices and the higher terms of trades. So something that is unusual about this flight to the dollar is the relative outperformance of emerging markets. If you go to the next slide. This is a very interesting graph which shows the implied volatility on sterling and euro. Now, what is implied volatility can best be defined as the price of insurance in currency markets, right? The more fearful markets are, the more volatility there is, the more anxiety, the more costly that insurance is. And as we can see, the sterling is a special case because of this additional volatility introduced by the crisis of the budget and the intervention of the Bank of England. The euro is perhaps a better indicator of how currencies in general, how volatility is being perceived. And we see that it is, while it is back up to the heights of the last 10 years, near the heights of the last 10 years, it's still significantly below the tremendous numbers that we saw right after the financial crisis. So that's we should put that a little bit in context, the fact that the levels of volatility are very high relative to the unusually quiet decade that precede this period. But in historical terms, we go further out, they're not so unprecedented. Nevertheless, here we are, much higher than we were just 2 years ago or even a year ago. And emerging market currencies, again, similar story, much higher than we were a year ago, 2 years ago, but still not quite at the panicky levels that we saw in the great financial crisis. If we go to the next slide. Central banks are still hiking rates. The Federal Reserve has led the way in the G10, has hiked by 300 basis points in March, which I believe is the fastest pace of tightening in history, though let's remember that we started from a very low level of 0%. Inflation is still running well above targets. There's not going to be any immediate relief from this relentless hiking of short-term rates. The Federal Reserve dot plot, which is the plot in which Federal Reserve members give us their best estimate on where rates are going to be at the end of each year, 2022, 2023, 2024. This expectation, the expectation of the average member of the Federal Reserve Open Market Committee was revised sharply higher in September. From it used to be and the expectation was that the terminal rate on Federal Reserve funds would be somewhere between 3 and 3.5. Now we're near 4.5, even higher. This is, I think, closer to a level of equilibrium. This is what we expected, and it clearly right now the Federal Reserve expects to hike rates all the way to 4.5%, and significantly for the first time, this agreement between markets and the Federal Reserve on that so-called terminal level of rates. The European Central Bank, on the other hand, has a lot of catching up to do. We expect at least another 75 basis point hike in October. Tightening will continue into mid-2023. The Bank of Japan remains the one G10 central bank that refuses to hike. It continues to buy unlimited amounts of bonds in order to keep the 10-year rate at a very extremely low 0.1%. The yen has underperformed significantly. Normally, in the current environment, it would do quite well, as it is traditionally considered a safe haven. Instead, it is one of the worst performing currencies. And the reason for that is that the Bank of Japan seems to be the only central bank that is content with this inflationary environment that will allow it to finally put the decades of deflation behind it, or at least that's how it's looking at the situation. Go to the next slide. Again, with expectation of the Bank of Japan, every central bank is in hiking mode. The Reserve Bank of Australia, perhaps in a harbinger of things to come in the quarter, hiked, but not quite as much as was expected. They cut by 25 basis points instead of 50. So it's sort of a signal, a willingness to return to the normal pace of hiking. Everywhere else, frankly, there's still no let up. We expect 75 basis points out of the Federal Reserve, either 75 basis points or an outside chance of 100 basis points out of the European Central Bank. And the big unknown will be how big will be the next hike of the Bank of England, given this conflict between the Tory budget on the one hand and the Bank of England dual mandate of keeping stability, of maintaining financial stability and returning inflation to target. We go to the next slide. Inflation is still way above central bank targets. Now, Japan and perhaps Switzerland are a bit of the outliers. There's some of these differences between the overshoots of inflation among the different countries have to do with differences in how the index is computed, but there can be no doubt that inflation way above target inflation is now a global phenomenon. We have only begun to see some signs of stabilization in headline inflation in the US and Canada. These signs are very tentative, and there's definitely no reason for the Fed to stop hiking anytime soon. But if we try to be a little bit forward-looking, it seems like core inflation, which is the inflation that strips out the most volatile components of energy and food, is stabilizing in the US and Canada, albeit at levels that are much higher than what the respective central banks are willing to tolerate. Go to the next slide. Recession risks are what is driving market fears and the sell-off in assets in combination with higher interest rates. That means higher discount rates for future earnings on stocks. It would be a bit unusual, given the experience for the past 40 years, to have simultaneously a problem with inflation and a recession. This is something that we had not really experienced in G10 economies since probably the 70s, but this is where we are. Inflation rates remain very high. Interest rates globally have risen sharply, albeit not as high as inflation has yet. The European energy shortage, or at least if not a shortage, definitely the spiking cost driven by the cutoff or the diminishing of Russian gas flows is yet another risk to the outlook. And then on top of that, we have this slowdown in Chinese demand driven by, on the one hand, the COVID lockdowns, on the other, the housing crisis, where sales of property and construction, which have been a significant driver of the Chinese economy over the last 10 years, seem to be taking a leg down. Now, our base case scenario is that in a situation of high inflation, full employment, still in most G10 areas, G10 economic areas, and significant household savings accumulated during the pandemic, the recession, any downturn will be mild, will be shallow and short. The main risk to this outlook, especially in the Eurozone, the main downside risk that we see is whether energy shortages materialize. As long as we stay in a situation where energy prices are high, but bearable, we probably don't have much to worry about. The question is, if we have a very cold winter or further disruptions of supply beyond Russian supplies, that would force rationing. And then we could see a much deeper downturn, especially in the Eurozone. We go to the next slide. The PMIs are right now the main reason we have to be cautiously, if not optimistic, at least not as pessimistic as others are. The PMIs are especially in the Eurozone, probably the highest quality leading index. Tells you what's going to happen next month. It's a very simple index that asks business managers whether they see more orders, fewer orders at the same level as last month. Right now, if we average the big G3, that's the UK, the Eurozone, and the US, we're near the level of 50, which is the line between contraction and expansion. That means that this overall index is consistent with either stagnation or a very mild contraction, but not a deep downturn. We need to pay very close attention, because if things take a turn for the worse, it will probably show up first in these indices. If you go to the next slide, I will pass the baton on to Matthew, who will go into more depth about each one of these areas, particularly what's going on in the US and with the Fed.
Yes, thank you very much, Enrique, and hello everyone. Thank you all very much for joining our webinar today. I'm going to start with a couple of things. First of all, as Enrique mentioned, we will have time for questions at the end of the webinar. If you do have any questions as we go, there is a Q&A function in Zoom, so feel free to pop any questions in the Q&A section of Zoom, and we'll get around to answering those at the end. The second thing, before we do move on, I wanted to ask you all a question. We like to engage everyone in our webinars as much as possible, and we're keen to hear your thoughts on some of the topics that we've covered, and we will cover in the next sort of half an hour or so. So I'm going to start up a poll very shortly. We've been talking about the uncertainty in markets and the potential downside risks to the global economy, and that's exactly what this first question in the poll is going to center around. So we're going to pose to you what you believe is the biggest downside risk to the global economy in the next 6 months. And we'll give you 3 options. They are rising central bank interest rates, possible energy shortages in Europe, or high inflation / the cost of living crisis. We'll also pose a second question. We've not quite touched them just yet. We're about to talk about our expectations for the G3 central banks, but we're going to pose to you, which central bank do you think will be the last to end its tightening cycle? Will it be the Federal Reserve, European Central Bank, or Bank of England? I'm going to set those polls up very shortly. Feel free to answer them now, or wait until we cover some of those topics in the next few slides. And once you guys have a chance to answer those, we'll get round to those, to the results of those polls at the end of the webinar. So we're going to kick off now. We're going to talk about, first of all, the US dollar, which, as we've mentioned, has raced to its highest level in 20 years against its major peers. A number of reasons as to why that's the case, as Enrique has touched upon. We've seen an influx of safe haven flows into the US dollar as markets fear a global recession. We've also seen a very aggressive tightening stance from the Federal Reserve, which has further supported the greenback. The Fed is very much still in aggressive tightening mode. It raised rates by another 75 basis points as expected at a September meeting, and looks set to continue raising rates aggressively at upcoming meetings as well. Headline inflation in the US appears to have stabilized. We had the latest data out around about 45 minutes or so ago, which once again surprised to the upside, but at least the headline inflation number appears to be trending lower. The issue for the Fed, however, is this core inflation number, which has continued to march to fresh highs and remains uncomfortably high. That rose to 6.6% last month, which was, again, was above expectations. So that's a concern for policymakers, and that is a rationale hiking stance. We don't think we'll see a dovish pivot just yet. In fact, at the September meeting, FOMC policymakers significantly revised upwards their interest rate projections, the FOMC's dot plot. We'll show that in the next slide. Communications from Fed policymakers have been very hawkish since the meeting. Powell has reiterated that the bank will keep at it, i.e. it will keep raising interest rates until it is confident that inflation is returning to 2%, rather than necessarily taking the foot off the pedal because they're starting to see signs of a peak. They're going to continue raising rates until they're confident of reaching their goal. And FOMC members on the whole appear to have some sort of consensus in favor of raising rates to around about 4.5% next year. And probably the key takeaway is that not only will they raise interest rates more aggressively than perhaps expected, but they're likely to keep them there for longer than previously anticipated. And so financial markets have reacted. Fed fund futures are now pricing in pretty much fully pricing in a 75 basis point hike. At the next meeting in November, at 130 basis points of hikes by the end of the year. So effectively a 75 in November, followed by another 50 in December. And as I said, markets are now pushed back their expectations for when the Fed will start cutting interest rates. There's a general consensus now that the Fed will keep rates at elevated levels probably throughout the rest of 2023. And this is the dot plot that I alluded to in the previous slide. So this was the interest rate projections from the September meeting. You can see each dot on the chart that represents a voting member on the FOMC and where they expect rates to be at the end of each year through to 2025 and in the longer run. The lighter blue thick or the solid line, I should say, that represents the median dot for the September meeting, and the dashed blue line, that's the median dot from the previous projections in June. So what you can see is we've had a very significant upward revision in the Fed's interest rate projections simply over a 3-month period. So it's very much a significant hawkish turn taken from the Fed. The FOMC now expects a median dot of 4.4% at the end of this year, which is up significantly from 3.4% expected in June, and a terminal rate, or what's seen as a terminal rate, i.e. the median dot for 2023, of 4.6%, which is again up quite sharply from 3.8% in June. So effectively, Fed members see continued aggressive policy as warranted. Another 75 basis point hike in November seems a done deal, particularly after today's inflation data, followed by a 50 basis point hike in December, and then perhaps additional hikes, we would think, likely at the February meeting, and then maybe we'll wait and see how economic data performs beyond then. But certainly no signs of it taking on the foot off the gas anytime soon. Another factor which has partly driven this outperformance in the US dollar is the strength of US data relative to its peers, at least. The US economy actually entered into a technical recession in the second quarter of this year, a relatively modest revised 0.6% annualized contraction in Q2 from a 1.6% annualized drop in Q1. Since then, however, data has held up reasonably well, and we would say better than what we're seeing in many other major nations. Particularly impressive has been robust levels of consumer spending. Domestic demand in the US remains pretty strong. Retail sales data, for instance, has shown positive growth in 7 of the past 8 months, which is encouraging. The PMI numbers, they've remained pretty mixed. Actually, the two different indices, one from ISM, the other from S&P, have given different results. So it's difficult to get a clean idea as to the state of things. The ISM index, however, remains comfortably in expansionary territory. The services PMI, 56.7 at the latest reading, which is very strong levels of expansion above the level of 50. The composite PMI from S&P has printed much weaker, just below the level of 50, 49.5. So that indicates mild contraction, but overall we think that the economy is holding up relatively well. No signs of a deep downturn just yet, or a prolonged recession. In fact, the Atlanta Fed GDP Now estimate, which is a running estimate of annualized US growth, that is putting Q3 growth at 2.9% annualized, which is a relatively healthy level of expansion. So we expect a pretty strong performance from the US relative to its peers in Q3, and possibly into Q4 as well. Again, perhaps another something that could support the US dollar as we go into year end. Much of this outperformance as well has continued to be driven by a strong US labour market. This has been a theme that we've seen throughout much of the last year. The US economy continues to create jobs at a pretty healthy pace. The last non-farm payrolls report showed 262,000 net jobs were added. We have seen a downturn, or a downtrend at least, in the pace of net job creation, but it's worth noting that we're very deep into the recovery from the COVID-19 pandemic. Actually, we're now at a stage where job creation is returning back to more normal levels. Before the pandemic, we used to say anything around 200,000, 250,000 net jobs created per month in the US was a very strong number. So I think this continues to indicate that the labour market's in good shape. Unemployment's at fresh 50-year lows, 3.5%. Nominal wage growth continues to remain pretty strong, around about 5%. So all in all, the US labour market is tight. That is likely to keep pressure on both wages and inflation. Again, continues to warrant this aggressive tightening stance that we're seeing from the Federal Reserve, which still has some room to go before it will consider pausing its hiking cycle. I'm going to move on now and talk about something that has undoubtedly been one of the main news stories in financial markets in the past few weeks or so, and that is, of course, the reaction in sterling, the reaction in UK financial markets to the fallout of the government's UK government's mini budget. Sterling, of course, fell sharply. It collapsed to an all-time low against the US dollar in the immediate aftermath of the budget, indeed the Monday after the budget that was announced on Friday. Sterling at one stage fell below the 104 level against the US dollar, which was a sell-off of around about 2% from peak to trough over a 2-day period, which is one of the more unprecedented sell-offs that we've seen in a major currency for some time. Investors were clearly left thoroughly unimpressed. In short, there were massive tax cuts, huge spending designed to offset the impact of the cost of living crisis, but no clear idea as to how these will be funded, and no clear idea as to when the UK government plans to balance the books. So what was announced? Well, most of the tax cuts were expected, but the government did go above and beyond what the market priced in. In short, the basic tax rate, that was lowered to 19% from 20%. The top tax rate, 45% tax rate, was ditched, although this has since been reversed. The recent national insurance increase from April 2020, that was also reversed, while the corporation tax increase, which was due in April next year, was cancelled. The government also pledged vast amounts of fiscal support for both households and businesses. Energy bills will be frozen for the next 2 years. The average household UK energy bill was set to increase to £6,500 a year in early 2023. That has been frozen at £2,500, so quite a significant difference, which we think was one of the big risks to the UK economy in the next 6 months or so. So this is but potentially a positive development for near-term UK growth. Businesses will also receive some relief from the energy bills, although that was likely to be more temporary for initial period of 6 months. But what does the budget actually mean for the UK economy? Well, we think that, actually in the near term, the inflation peak may be lower, and the risk of this recession may also be lower. The biggest risk that we thought to the UK economy over the next 6 months or so was this sharp increase in energy bills. So the freezing in household energy bills, we think, may lower the risk of a recession in the immediate term, certainly lowers the risk of a deep downturn, while the inflation peak is likely to be lower than it would have been prior to the budget. The Bank of England had penciled in headline UK inflation of around about 13% in October. We think that could peak more and around the 10% level. The problem is, and the issue for markets is not what happens in the near term, but what happens over the more medium term. And clearly investors see the outlook for the UK economy as worsened following the budget rather than improved. And we've outlined here 3 reasons and 3 main consequences we see of the budget that could lead to this assessment. First of all, inflation is expected to stay higher for longer, even if the peak may be slightly lower. This is due to the expected higher disposable incomes as a result of the large tax cuts. The IMF has released a report this week saying that the UK is set to have the highest inflation rate in the G7 by the end of 2023 of around about 6%, which would be higher, or is expected to be higher, than almost every other country in the Eurozone, bar I think one. I think only Slovenia is expected to have a higher inflation rate by the end of next year. So that's concerned markets and concerned investors who expect higher costs to erode real incomes and lower standard of living. For its part, the Bank of England is also expected to raise interest rates more aggressively following the budget. There was no emergency interest rate hike or direct FX intervention following the sell-off in the pound, although there was speculation we would get some. But the Bank of England has indicated that a significant interest rate hike is coming at its November meeting. And it already admitted in September that it expects inflation to be higher as a result of the budget rather than lower. So the market's pricing in an aggressive pace of hikes from the BOE. A 100 basis point hike is mostly priced in for November. And investors now see a base rate of almost 6% in 2023. So they're both significant risks to growth. At the same time, and something that has really rocked confidence in UK financial markets, UK borrowing is set to rise sharply at a time when interest rates are already rising. The UK government will need to borrow huge amounts of money in order to pay for this shortfall. Not only that, but they'll need to borrow at significantly higher interest rates. If we look at the 20-year UK gilt yield, for instance, that's risen to around about 4.9%. From around about 1.2% at the start of the year, and has increased significantly since the budget. But why is that? Well, that's a combination of, first of all, interest rate expectations have risen, which generally leads to higher yields. The government will also need to issue extra debt in order to pay for these tax cuts. So extra supply of government bonds to the market lowers the price on those bonds, and due to the inverse relationship between the bond's price and its yield, the yields have increased sharply. What does that mean? Well, it means that, first of all, of course, the cost of government increased significantly. And second of all, perhaps more important for the UK economy, is the impact it will have on households and businesses. This is already beginning to feed its way through, of course, to higher mortgage rates, which will impact rents. And ultimately, the market believes that the budget could have more negative impact, or the impact of the budget could negate any positive that there is from the tax cuts in the near term. So they see, as I said, the outlook for the UK economy as worsened. Having said that, the pound has rebounded relatively well since its lows. It rebounded pretty sharply in the week or so following its record low against the US dollar. There was a number of reasons as to why that was the case. I mean, first of all, the dollar was broadly weaker during that period. So while sterling did outperform its peers, the dollar was actually slightly softer against most other currencies. But perhaps the 2 main reasons we've outlined here. First of all, the Bank of England has intervened to calm the situation in UK fixed income markets. The Bank of England announced its temporary bond buying program, whereby it would buy UK government bonds using its reserves in an attempt to allay the rout in fixed income markets and prevent another move higher in yields. Unfortunately, it plans to end this program on the 14th of October, i.e. tomorrow, and there is concern among markets that additional intervention will be required beyond this date. Governor Bailey spoke earlier this week, indicating that these measures will indeed end tomorrow, but there is high speculation that they will need to extend that beyond this week. Really, this sort of puts the Bank of England in a bit of a no-win situation. Either it extends the purchases and potentially damages credibility, or it ends the measures as planned and risks another sharp increase in UK yields. We've also seen a U-turn, as I mentioned, a U-turn on the government's most controversial new policy change, and they've removed the 45, or they've scrapped the plans to remove the 45p tax rate. We see that as a little bit more of a symbolic gesture. Actually, this only accounted for 4% of the tax cost over the next 5 years. And that's one of the reasons why we think that actually sterling may not be out of the woods just yet. The fact that this U-turn is a relatively small amount of the overall cost, and the fact that the Bank of England's measures to calm the bond market are temporary, means that we could see some additional downside in sterling, we think, in the immediate term, particularly given the fact that investors continue to see the medium-term outlook as worsened. S&P and Fitch have both downgraded their credit outlook for the UK economy to negative from stable, which is a concern for investors. We think it may take potentially a change in Tory leadership to enable a more meaningful rally. Earlier today, that the Tory party is considering a more dramatic U-turn on its policy. We haven't had details of that just yet, but if we were to see some concessions from the UK government on some of these measures, again, that could be positive for the pound. What does that mean for the Bank of England? Well, I mean, since the budget, financial markets have gone into overdrive, pricing in higher Bank of England interest rates. They have ramped up their expectations for the policy rate through to the end of 2023. And markets were actually left disappointed by the fact that there was no emergency rate hike, nor any intervention in the FX market. That shouldn't be too much of a surprise, given how low the Bank of England's reserves are, less than 2 months worth of import cover. And that emergency rate hikes really only provide temporary support for currencies. But MPC members have suggested that a significant rate increase is on the way. The size of that hike is unknown. Whether that means a 75 basis point hike or 100 basis point hike or 125, it is unclear. Swaps, though, are pricing in, almost fully pricing in, a 100 basis point move in November and more than 200 basis points of hikes through year end. Actually, we think it could be quite difficult for the Bank of England to meet these quite lofty expectations. The market is looking at a Bank of England policy rate of around 5.5 to 5.7% by mid next year. And we think it could be quite difficult for the MPC to meet those expectations, particularly given its recent penchant for surprising to the dovish side. So perhaps the Bank of England policy could present a little bit of downside for sterling in the next few months. Right, we'll move on now and talk about another significant risk factor to the global economy and indeed financial markets, and that's the European energy crisis and its potential impact on the euro. And there's a general acknowledgement in markets that a downturn in European growth and possibly more likely a recession or recessions are on the way in Europe this winter. There's a number of downside risks to European growth at the moment. We've outlined a few of them here. Undoubtedly, we have to say the biggest downside risk to the European economy is a possible energy shortage as a result of the tough sanctions imposed by the EU on Russia, as a result of course, the war between Russia and Ukraine. We'll outline in the next few slides as to why we are relatively optimistic and believe that rationing of energy won't come to pass, but that is a very real possibility, and markets are very much wary of that. Inflation is also at record highs. Headline inflation in the Eurozone has risen into double digits for the first time ever, 10% last month. And unlike the US, has shown no signs of peaking just yet. Economic activity data has also deteriorated. As we've shown, the business activity PMIs have worsened and are now indicating a shallow downturn, which is concerning investors. The ECB is also raising interest rates aggressively. Actually, it's lagged behind most of its G10 peers, particularly the Federal Reserve, in raising rates, but it is now in full-blown hiking mode, raising rates by 75 basis points at its last meeting and looking likely to do the same at its next one later this month. And of course, we continue to see geopolitical escalation and ongoing bad news out of the war between Russia and Ukraine. All of these are concerning investors. They're damaging consumer confidence in the Eurozone, which has fallen to a record low, and ensure that a downturn and recessions now look very likely. The ECB itself is penciling in a technical recession in the bloc this winter, and only very modest growth of 0.3% in 2023. How has the euro reacted? Well, I mean, the euro is, as you can see, euro dollar has fallen below the parity level for the first time in 20 years. It's slipped below that level, I believe, for the first time in July. Spent most of September around the parity mark, but has made a fresh move lower. And the time of this webinar is around about the 0.97, 0.98 level. A lot of this move lower, of course, has to do with strength in the dollar, but concerns over possible shortages of energy during the winter have also contributed to the move lower. Prior to the war, Russia accounted for around about 40% of natural gas imports into the EU and around 20% of oil imports. Now, obtaining alternative oil is not necessarily a significant issue for the bloc. Oil is slightly easier to transport than natural gas, which does require existing infrastructure to be in place. It's very timely and costly, of course, to create new gas pipelines. So a shortage of natural gas is a big risk and is a big, potentially a big problem for the Eurozone economy. Particularly on the news of the Nord Stream 1 gas pipeline, which is the main gas pipeline between Russia and the EU. That will be closed indefinitely. And actually natural gas supplies from Russia to Europe are now 25%, actually I think it's slightly below now, 25% of pre-war levels. So that's a concern for markets, and investors are wary of the possibility of a total cut in Russian energy to Europe, which we think would lead to a deep downturn in Eurozone GDP. The IMF is projecting around about a 2 to 3% drop in EU GDP as a worst case scenario, should Russia cut off energy supply completely to Europe, should there be severe shortages, and should there be potential rationing of energy. Having said that, we think that or at least our base case scenario is for a shallow recession in the Eurozone. And we think that, or we are at least optimistic, that energy rationing, outright rationing, will be avoided. Why do we have this optimistic view? Well, we have to say, and we have to acknowledge, first of all, that rationing cannot be ruled out. And certainly the possibility of that being the case has increased in the last few weeks and months. But we are hopeful that it will be avoided. So far, the EU has made very good strides in building up its gas storage. The EU has already filled its winter gas, natural gas storage to 91% capacity, or just above 91% capacity, above the EU's target of 80%, and modestly above the 5-year average. Estimates are varied as to how much of this spare gas supply will be needed this winter. We look at a report from the International Energy Agency, which has done a scenario analysis and is assumed a complete cut in Russian gas, i.e. a worst case scenario, and assuming no demand restrictions. They expect storage to fall to 20% capacity in February, which at very low levels relative to previous years, but it would suggest we think that there's just enough to make it through the winter. Generally, supplies and capacity reaches a trough and starts to increase by the end of March. So that would put total capacity of around about, we estimate, 10 to 15% by the end of March, assuming that it's not a long and cold winter. But the European Commission has asked its members to reduce gas usage. According to this report from the IEA, a 9% cut in usage would lead to an increase to 25% capacity by February, with a 13% cut to lead to 33% capacity, which is actually in line and consistent with levels we've seen in the past few years, with the exception of 2020. A big risk factor, of course, being potentially if we do have a very cold, unusually cold winter in Europe that extends deeper into 2023, then we could, the EU could be scraping the barrel of its energy supplies. That's when we could start seeing possibility of energy rationing, which we think would be a big downside to the Eurozone. Another supportive factor, however, is that we have seen large-scale fiscal support from governments in the European Union. You can see from the chart on the right-hand side, this represents the state support in order to cope with this cost of living crisis and the potential energy shortages from countries in Europe as a percentage of GDP, and they've been pretty significant support packages. We think that more is yet to come, and we think this should soften the blow to the European economy during the winter. This is a visual representation of what we were discussing in the previous slide. So this chart represents the percentage point increase, the percentage point change we've seen in EU natural gas storage over a 6-month period. So how much of an increase in percentage point terms have we seen in natural gas storage in Europe in the last 6 months? The dark black line, that represents this year, 2022, with the dashed lines representing the previous 4 years. You can see that the EU has managed to accumulate its natural gas storage at a faster pace this year than it has done actually in each of the last 10 years, with the exception of 2018. Albeit this was from unusually low levels this year, and actually the fact that this natural gas storage only accounts for around about 25 to 30% of overall gas usage, the possibility that we do get a colder than expected winter, the possibility that Russia completely cuts off gas supply. These are all risk factors to the situation, and risk factors that could lead to potential shortages of energy. As I said, if that was to be the case, we're likely to see a pretty significant downturn in European GDP, and we would have to revise lower our euro forecasts as a result of that. Now this chart, this is taken from the IMF. This represents the potential output loss, so the potential contraction in GDP as a result of a cutoff in Russian energy over, I believe, this next 6 to 12-month period. Hopefully you're able to see the names of the countries down the bottom. So clearly you can see that the impact on countries in the bloc and in Europe in general is likely to be varied. According to the IMF, a complete cut-off in Russian energy would be a worst-case scenario for some of the countries in Central and Eastern Europe, the likes of Hungary, Slovakia, Czech Republic, could see, under a worst-case scenario, a contraction of anywhere between sort of 3 to 6%, including Italy, and the IMF believes could be set for a significant downturn. Whereas on the other end of the spectrum, the likes of Spain, France, UK would actually suffer relatively mild downturns. So the impact would be varied across the bloc, and it'd be very much dependent on a number of factors, of which I've already mentioned. Overall, though, as I said, we're hopeful that rationing will be avoided. We're hopeful that supplies will last through to the end of March next year. The sourcing of alternative energy sources has been encouraging, and we are hopeful that these worst case scenarios for Eurozone growth and European growth will be avoided. And now some of the headlines in much of the past few months have also centered around the European Central Bank and its response to rising inflation in the euro area. As I said, Eurozone inflation has broken to a record high into double digits for the first time in history. This is, again, a concern for policymakers in the European Central Bank. The ECB has raised its interest rates aggressively in order to combat this. And markets are eyeing another big hike in the next meeting in October. A 75 basis point hike is very likely. With the ECB, we think to hike deeper into 2023 than the Federal Reserve, which we think could provide some support for the euro next year, albeit clearly there are a lot of downside risks to the common currency before we get to next year. Energy shortage over the winter months being top of that list. We're going to talk very quickly on how risk currencies have reacted to these downside risks to growth and to these recession fears before we go to the questions. For the most part, as Enrique mentioned at the beginning, lower risk currencies in the G10 have outperformed their peers in the past couple of months. The Swiss franc, aside from the US dollar, the Swiss franc has been the best performer. That has to do partly with its safe haven status. Also, we've seen quite a historic policy reversal from the Swiss National Bank, which has lifted its main policy rate above zero for the first time since 2015. It's also ended its FX interventions that are designed to weaken the Swiss franc. It has a higher tolerance for a stronger currency in order to rein in inflation. So that's supported the Swiss franc. The yen would be the outlier among the safe havens. Again, as we mentioned, that largely has to do with the easing stance adopted by the Bank of Japan. At the other end of the spectrum, we have New Zealand and Aussie dollar, which have suffered among the largest sell-offs, along with sterling. We attribute that to concerns over possible slowdown in growth, much weaker growth in China, which has continued to pursue its zero COVID policies, continued to experience a housing crisis. Commodity prices also dropped from their highs in June. Again, that's negative, a negative development for the likes of the Aussie and New Zealand dollar and some of the high-risk currencies in general, which, as you can clearly see from this chart, have underperformed the lower risk assets and lower risk currencies in the last few months. Lastly, onto emerging markets. You can see that we've had, again, an idiosyncratic performance among emerging market currencies. But as we've mentioned, generally they've outperformed the majors, in large part due to the very aggressive hiking processes we've seen among these emerging market countries. Probably the biggest or most notable trends that we're seeing is, first of all, an outperformance in the Latin American currencies. You can see from this chart, Chilean peso, Mexican peso, Brazilian real, Peruvian new sol are top of the tree in the last 4 months, with many of them actually outperforming even the US dollar. We think that has to do partly with high commodity prices, which has supported these currencies, and secondly, relatively high real interest rates in the region. We then, on the other end of the spectrum, we have some of the underperformers, many of which have been the European currencies, not just among emerging markets, but also in the G10, particularly those currencies and those economies that are acutely exposed to the Russia-Ukraine conflict. And of course, the longer that drags on, the more vulnerable these currencies could be to additional losses. One currency I would like to point out as well before we wrap things up is the Chinese yuan, which has performed uncharacteristically poorly in the last few months. The yuan tends to hold its value very well, but given the significant downside risk to Chinese growth, which I've already mentioned, particularly the zero COVID policy, easing of monetary policy from the PBOC, and the housing crisis in China, that has dragged the yuan lower, and that has partly dragged some of these emerging market currencies with it. But overall, they have still outperformed most of the majors. Excellent. So that's everything from us in terms of content. Before we move on to the questions, I'm going to recap the results of our poll. And thank you, everyone, for all of those that contributed to this. We've had 148 of you that have answered these two polls. I'm going to end the poll now, and I can reveal the results. So the first question we posed to you was, what do you think is the biggest risk to the global economy in the next 6 months? 14% of you put rising central bank interest rates, so that was the lowest of the three. And then it was quite close between the other two options, 39% saying a possible energy shortage in Europe, but 40%, so almost 50% of you think that the biggest risk will remain high inflation and the cost of living crisis. I would tend to agree with that one.
Yes, and that's in agreement with what the central banks seem to think. They seem to be much more worried about inflation becoming entrenched than they are about the impact of higher interest rates. By the way, there were a handful of very good questions in the Q&A. Because I knew that we were running a little bit short on time, I decided to answer them in writing, so they're available for everyone to see, I believe. And they're very good questions about the US dollar, the euro, and one of them about the Canadian dollar. So thank you for that.
Excellent. Thank you, Enrique, for that. Yes, we were a little bit short of time, which is on me, but yeah, so the second poll that we had also was surrounding central bank monetary policy, and we asked which central bank would be the last to end its tightening cycle. Actually, 55% of you, more than half, have said the European Central Bank, which is interesting. 24% Federal Reserve, and 21% for the Bank of England. So thank you, all of you, for contributing to those polls, and for those of you that have submitted questions that Enrique has answered in the Q&A. I don't know if we would like to answer any more questions. Enrique, do you think we have time perhaps for one or two more questions, if anyone has any?
Yes. Are there? Here's a couple more. Okay. What do you think might be the impact on the UK housing market and the knock-on implication as a result of recent movements? Matthew, you're probably better placed to answer that because you have your boots on the ground.
Yes. Well, I mean, we've had a few reports out in the last couple of days or so regarding the UK housing market. One or two reports saying that house prices in the UK could be as much as 25% overvalued at the moment. So far, we've not necessarily seen any significant signs of a downturn in house prices in the UK, but given the budget announcement, given the fact that mortgage rates are now going through the roof, that ultimately is likely to have a knock-on impact on house prices. So, I mean, my personal opinion, I think it's only a matter of time before we start seeing retracement in house prices in the UK, which have gone up very sharply, particularly since the pandemic begun, certainly in the last 2 or 3 years or so.
And the last question is, based on all the forecasts of PMI, central banks' interventions and interest rates, do you expect the US dollar performance on similar level in 2023? That's the key question, and a couple of the ones I answered in writing were in the same direction. Clearly, there's reasons for US dollar strength, but it is also true that the rally has been almost unprecedented. A lot of, when the euro is so cheap and the dollar is so expensive, a lot of US outperformance is already in the price. We think that there's room for the euro to do better than expected, both in terms of the economy. If the winter is not particularly cold and there's no further damage to the supplies, even assuming no Russian gas comes in. Europe should be able to make it through the winter without rationing. And in addition to that, we do expect that at some point in 2023, the Fed is going to stop hiking and let the effect of the existing hikes filter through the economy, while the ECB is still in full-on hiking mode. I think that the expectations for hikes for interest rates in the European Central Bank are still very low, and there's room for those to correct higher. As they do, that should provide some support to the euro, which, as I said, it's extremely cheap by any metric at any level below parity. The last question: when natural gas Russian supply would be zero all 2023, what will be the economic effects you in and after winter 2023? Well, that's a very good question, but we're right now focusing on the winter of 2023. We do think that longer term, there's more room for improvement in the supply situation, more room for taking advantage of the low-hanging fruit in terms of lowering energy consumption, routing liquefied natural gas. Again, we're not exactly experts on the natural gas market. We do think that under reasonable expectations, Europe should come out through this winter okay. And the longer term is an open question.
Yeah, I would add, never has the weather been so important to currency markets. And if we do get a very cold winter in Europe, that could present a significant risk, not just to the European economy, but to the euro.
Okay.
Excellent. I mean, I think we're just about done for time now. It's we've just gone past the hour mark. So yeah, I mean, hopefully you've had all your questions answered. Hopefully you've enjoyed the webinar. Thank you all again very much for joining. We all very much appreciate it. And we'll let you know when we plan to do another one. We tend to do these global webinars sort of once a quarter. So we'll keep you updated as to when the next one will be and to what topics we'll cover. But thank you everyone again very much for joining.